Next for HP, Inc., the old Hewlett-Packard PC and printing business. Now that we're in the first inning of a new product cycle with a wave of AI-powered personal computers hitting the market, a director on the company's board, the company has now appointed Enrique Lores. He's currently president of HP's imaging, printing and solutions business. HP CEO Enrique Lores just revealed they are leaving the US and moving abroad after newly elected US President Donald Trump announces tariffs on trade partners. And trade partners also retaliated, with tariffs making it too expensive for other countries to buy from US and US businesses to buy from other countries. This startling declaration from the head of one of the largest technology and printing giants underscores the depth of concern rippling through the corporate world as geopolitical maneuvers reshape the contours of global commerce. Before we start, please don't forget to like and subscribe to our channel for more updates. The moment Laws chose to share this decision came on the heels of sweeping announcements from the White House that called for steep duties on steel, aluminum, electronics components, and various consumer goods key exporters including the European Union, China, Canada, and Mexico. While the stated aim was to bolster American manufacturing and protect domestic jobs, the immediate effect created an undeniable tension in supply chains that many multinational companies rely on. Hewlett-Packard found itself caught between higher import costs for raw materials, retaliatory levies on its finished products, and an unpredictable regulatory environment that threatened to upend carefully calibrated strategies forged over decades. For HP, the decision to shift its headquarters and significant operational capacity outside US borders was not one taken lightly. The company's roots in Silicon Valley run deep, dating back to its foundation as a garage startup. Over the years, it has stood as a witness to the US tech boom, hiring generations of engineers, managers, and designers who have called the Bay Area home. Yet, today's reality dictated that remaining anchored in the States under such heavy trade constraints would inevitably erode profit margins and diminish competitive advantage. By selecting a new jurisdiction, one with more stable access to supply networks and tariff-free trade corridors, HP aims to stabilize production costs and protect long-term growth. Employees across HP's sprawling campuses in Palo Alto, Roseville, and Houston awoke to news that would prompt uncertainty about their future. The lines between corporate strategy and community impact blurred as local governments scrambled to offer incentives designed to retain jobs and maintain regional tax bases. Political leaders once heralding HP as a crown jewel of American innovation now found themselves negotiating with executives who held the power to move thousands of roles overseas. The new hub, situated in a country boasting multiple free trade agreements, promises more streamlined logistics, lower duties, and simplified customs procedures. This would safeguard HP's ability to bring products to market swiftly and at competitive price points. A lifeline when rivals are forced to pass higher costs onto customers or absorb shrinking margins. Beyond the immediate financial calculus, the move signals a shift in corporate confidence away from US policy predictability. For decades, companies like HP have built global roadmaps around the assumption that trade policies would remain largely stable or at worst subject to incremental changes. The sudden imposition of broad-based tariffs, however, has shattered that assumption, prompting businesses to hedge against political risk by diversifying their geographic footprints. Seen through this lens, HP's relocation serves as a bellwether for other multinationals reevaluating their exposure to USC-centric supply chains and regulatory environments. Consumers around the world watch the developments with mixed reactions. On one hand, the notion of HP relocating operations felt like yet another blow to America's manufacturing identity. Critics lamented the loss of domestic production of laptops, printers, and server equipment once proudly labeled Made in USA. On the other hand, customers in Europe and Asia anticipated the potential upside of more readily available devices, shorter delivery times, and perhaps even lower prices if HP leveraged cost efficiencies abroad. The tension between national pride and pragmatic purchasing decisions underscored the complexity of modern consumer sentiment. Analysts scrambled to revise their forecasts for HP's fiscal performance. Projected earnings took into account the one-time costs of relocating offices, severance packages for affected staff, and the setup expenses for new facilities. Yet, these transitional costs were weighed against longer-term savings from reduced import duties and greater access to emerging markets. The calculus extended to currency hedging as well, since operating in a different base currency would expose HP to new foreign exchange risks, tempered by potentially lower operational expenses and regional tax incentives. The broader tech sector took note. Companies with sprawling global footprints from hardware makers to software firms began covertly reassessing the distribution of their manufacturing and research centers. Some engaged in contingency planning, drafting blueprints for alternative headquarters, while others quietly reopened dialogues with friendly governments offering advantageous trade terms. The specter of a U.S. business exodus prompted urgent appeals from industry associations, urging policymakers to consider the collateral damage of protectionist measures on domestic competitiveness. Meanwhile, financial markets reacted with volatility. HP's stock experienced swings as investors digested the risks associated with the relocation. A dip followed the initial announcement, reflecting concerns over operational upheaval and the uncertain reception of new products, challenges arising in foreign regulatory landscapes. Yet later trading sessions saw a rebound fueled by optimism that tariff avoidance would ultimately fortify margins. This rollercoaster in share performance exemplified investor worries about the intersection of politics and profit. In an era where companies are vanguards of both commerce and diplomacy, the political response in Washington was swift and polarized. Lawmakers from both sides of the aisle condemned the move as detrimental to the national interest. Some called for special exemptions for strategic industries, while others doubled down on the necessity of protecting American jobs, arguing that corporate flight risks were a byproduct of companies refusing to embrace domestic manufacturing innovation. The debate intensified over whether further legislative action or regulatory relief could coax HP and similarly poised firms to maintain a U.S. presence despite the headwinds. Internationally, governments seized the moment. The host nation courtship of HP became a geopolitical triumph, showcasing its ability to attract marquee corporate tenants with promises of streamlined customs, robust intellectual property protections, and attractive tax credit. Trade ministers from rival countries decried the disruption, warning of a domino effect as other Fortune 500 companies considered following suit. Global trade organizations pondered the implications for multilateral agreements, questioning whether the current discord signaled a broader retreat from the principles underpinning decades of economic integration. Supply chain partners from component suppliers to logistics providers faced their own reckoning. Those that historically relied on US-based distribution hubs found themselves negotiating new contracts, establishing facilities closer to HP's new headquarters, and overhauling inventory management systems. Relationships once anchored in American infrastructure had to be reimagined to fit the contours of this new operational map, creating both challenges and opportunities for service providers who could adapt swiftly to the shifting tides of corporate strategy. Labor. Unions and employee advocacy groups raised concerns about job security, career stability, and the fairness of sudden corporate relocations. Negotiations around severance terms, relocation packages, and unemployment support dominated headlines in regions slated for downsizing. Meanwhile, the labour market in the destination country prepared to absorb an influx of talent, prompting universities and vocational programs to adjust curricula to meet the skill demands of a leading technology enterprise. Amidst these seismic shifts, HP's leadership maintained that innovation would remain the company's North Star. Research and development operations, the lifeblood of any technology firm, would continue at distributed centers worldwide, with an emphasis on collaboration across time zones and cultures. The relocation promised new synergies as teams reoriented themselves in an environment unhindered by punitive trade measures, potentially accelerating the rollout of next-generation computing platforms and sustainable printing solutions. Environmental considerations also factored into the decision. The energy profile of manufacturing facilities abroad, access to renewable power sources, and proximity to suppliers of eco-friendly materials all contributed to a greener operational footprint. HP framed the move as part of its broader commitment to sustainability, even as critics argued that the shift betrayed America's leadership in corporate environmental responsibility.